On Friday, July 24th, Leopold Aschenbrenner wrote to his investors that his crashing fund was up 439% this year. The letter called the crash a buying opportunity, fresh capital welcome starting August 1st. The margin calls came sooner. By the following Thursday's opening bell, $16 billion of stock was gone. The buying opportunity window never opened. Before we rewind, meet this money machine they built. 1 jar of investor money, 3 more borrowed on top, $4 working for every $1 owned. When the positions rise 10%, the jar earns 40. That's the whole trick. It has no other setting. When the positions fall 25%, the jar is empty. 0. That's the arithmetic. Keep the jar where you can see it. It's about to run like a stallion in one direction for 20 months. June 2024. A 165-page essay appears online. Situational Awareness, the Decade Ahead. Its thesis, quote, AGI by 2027 is strikingly plausible. Its scale, a chapter titled Racing to the $1 Trillion Cluster. And on the author's page, something essays don't usually carry. An investment firm, announced in the same document. Anchor investors, Patrick Collison, John Collison, Nat Friedman, Daniel Gross, the founders of Stripe, the former CEO of GitHub. The essay is the pitch. The pitch is the essay. The fund is named after the document. Situational Awareness, LP. Leopold Aschenbrenner, Columbia's valedictorian at 19. Then OpenAI's superalignment team. In April 2024, OpenAI fired him, reportedly for leaking. He disputes that. He says the document was a brainstorming memo, and the real trigger was a security warning he took to the board. OpenAI says the security concerns didn't lead to his separation. That dispute is part of the record. Anywho, so what happened next? A reported $225 million in seed capital, trading by the end of the year. And start they did, with incredible results. First half of 2025, up 47% after fees. Full year, roughly 200%. First half of 2026, up 439% net. Cumulative, by June, more than 1,000%. Jane Street became an investor. One more important thing before the machine speeds up. The returns alone don't get you to the fund's meteoric rise to secure $20 billion in investor capital. 1,500% on the seed is about $3.7 billion. The rest was new money, arriving in size on top of the crazy run. Performance built the legend raised the assets, and the assets met the leverage. The fund ran a leverage of as much as 4 times its capital on the public book. Financed through 3 prime brokers, Goldman Sachs, JP Morgan, Bank of America. 4x, running up. The semis rally, the jar multiplies, the returns pile higher. Borrowed conviction has a very unique characteristic. On the way up, borrowed conviction is indistinguishable from genius. The gauge does not know which direction it's running. Remember that, it doesn't. By early July, roughly $20 billion of investor money, swollen with leverage, rose to some $45 billion in assets. That's CNBC's count. Its last public filing, a March 31st snapshot, showed $13.7 billion in reportable securities, obsolete the day it filed. July 10th, SK Hynix, the memory maker at the center of the AI build-out, raises $26.5 billion on the NASDAQ, a record listing. The cornerstone investor? Situational Awareness. Hold that date. July 10th. A lot happened in the following 20 days. June 22nd. The Philadelphia Semiconductor Index closes at a record. Then, July. The index falls 28.6%, peak to trough. Morgan Stanley's Tech Momentum Basket? Down 53.5. Now watch the machine, the same machine, run in reverse. Nothing about it changed. Not the jar, not the borrowed $3, not the arithmetic. The only thing that changed was the sign. June's peaks gave way to the July 29th lows. SK Hynix, down about 47% in Seoul. Nebius, down 43. Micron, down 39 from its June record. CoreWeave, down 36. Bloom Energy, about 40. Now the arithmetic from minute 1. At 4x, a 25% decline is 100% of your equity. These fell 35 to 47. Look, the essay might still be right. The clusters may still get built, but it changes nada. A margin call doesn't wait to find out whether your thesis is true. Being early on borrowed money settles exactly like being wrong. Also, margin calls don't care about essays. So back to Friday, July 24th, the letter Leopold wrote. Now you know what it's sitting on. The fund calls the sell-off, quote, one of the best buying opportunities in over a year. It invites fresh capital, committing from August 1st. Some investors were offered the chance to buy assets straight from the portfolio. Tuesday the 28th, Wall Street's collateral demands start landing. Wednesday the 29th, the margin calls crest. Goldman, JP Morgan, Bank of America, his 3 lenders. The calendar had 6 days on it. The money he invited was due to start arriving August 1st. The lenders arrived first. Thursday, July 30th, before the opening bell. The brokers have been selling pieces of the book so the fund can meet the calls. What remains, the bulk of a portfolio once estimated at $16 billion, goes to Citadel. One negotiated transaction, a reported 10% discount. 2 other bidders reached for it, Millennium and Jane Street. Yes, the investor. Citadel got there first. The Financial Times called it one of the largest and most sudden stock transactions in Wall Street history. The buying opportunity window never opened. No banks were hurt in this settlement. None has reported a loss on the unwind. Bank of America's CEO called it, quote, a warning shot for leveraged markets. Citadel did well, bought at a discount. What it made, undisclosed. The investors hold what's left, about $10 billion, down 67% in July, which leaves the fund, this is from its own letter, up 80% on the year, a number most funds would frame on the wall. This one cost $35 billion. What stayed on the shelf? The private stakes. A position in Anthropic entered February 2025 when the company was valued just above $60 billion, marked around $5 billion when the dust settled, roughly a fifth of the fund's assets in June. Anthropic's latest round values the company at $965 billion, 16 times the entry valuation in 15 months. Also MatX, also FluidStack. Now, why did these survive when everything else went? The public stocks had a price every single day, and that price is what the lenders lend against. Every afternoon it told them exactly what their collateral was worth. When it fell, they could demand cash by morning. That's where the leverage lived, so that's where the calls landed. The private stakes worked the other way around. No daily price, no daily mark for a lender to watch, and no borrowed money against them in the first place. Nothing to measure, nothing to call. And still, Bloomberg reports he tried to sell them in the panic. Sequoia and Green Oaks were approached. The Citadel deal closed first. He kept them. 6 days after the fire sale, Tuesday, August 4th, the fund wired $400 million into a private company Bloomberg couldn't name, on top of $100 million the month before. $500 million into a mystery. 2 days later, the Journal named it Source Foundry, a chip tools startup. The leverage, per the fund, removed. And the coldest fact on file? Bloomberg, August 7th. Investors are asking to get in. The fund, currently, is not taking new money. Let me leave you with this really well-written part in his letter to investors. Dated July 31st, 2026, the day after the fire sale. In it, this. These were very expensive scars, but I am dedicated to ensuring they will be invaluable lessons. And then the sentence to keep. We took the steps that were necessary to fight another day, but our fund must always be structured such that we can take a loss and fight another day. They must love the James Bond franchise.